Test for the stenographer. Test, test, 1, 2, 3, test. Test for the stenographer. 1, 2, 3, test, 1, 2, 3.
so we'll let our former colleague. The Subcommittee on Digital Assets, Financial Technology, and Inclusion will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. The hearing this morning is entitled Modernizing the Financial Services Through Innovation and Competition. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I want to thank our great panel of witnesses for being here. I now recognize myself for 4 minutes to giving an opening statement. Having used an extensive amount of time over the last few months to work in a bipartisan fashion to craft digital assets bills, one on payment stablecoins and the other on taking hearings and crafting a regulatory framework for digital assets, I'm excited today that the committee comes back together to explore financial technology issues more generally, which is a major focus of this subcommittee. Since our task forces that Mr. Lynch and I were involved in back in 2018 and 2019 on fintech and on AI, today we want to continue that broad foundation regarding the state of fintech today, and specifically the innovative products and services that financial technology enables for our consumers. My goal is for members to use the time to better understand the fintech ecosystem and its evolution from, when we were together 4 and 5 years ago, disruption to much more of a sense of collaboration and how it can deliver products and services that consumers want and can benefit from, and the policy questions that we should be thinking about as lawmakers. At a time when there's so many exciting new technologies like digital assets, quantum computing, and the greater use of artificial intelligence, it's important to remember that innovation and technology have always been at the heart of financial services. That's true even of the humble ATM, which changed the way we thought about cash and credit, how we pay for things, how we have access to money over the past 50 years, to access that cash whenever we want it, whenever we needed it, and that was no small feat back in that 50-year-ago time frame. But like the ATM, I believe that fintech today has the potential to drive even greater innovation in financial services while also delivering even more custom, customer-centric experiences based on trust, convenience, and service in an increasingly digital world. For example, earned wage access products allow people, as the name suggests, to access their wages as they earn them. This can give people flexibility and liquidity to meet short-term credit needs, like when a bill is due next week, but payday isn't until the end of the month. The same goes for bank fintech partnerships, where a great way that community banks in Arkansas are meeting customer demand through new products and services at a scale through white label offerings. Or buy now, pay later products, like the old layaway systems which many of us grew up with. This gives consumers a technological way to have choice at checkout and more flexibility to pay on their own schedule in a way that they can easily understand. The massive rise in popularity of these kinds of financial products demonstrates that consumers already recognize how these innovations are improving their lives. However, changes driven by technology also merit thoughtful consideration of how they affect existing laws, regulations, and particularly if laws and regulations inhibit that innovation. The key is that we have balance between both consumer protection and innovation. And that being said, I think the benefits of fintech firms and the products and services they provide far exceed the risks that they might well pose. And that's why I'm excited about the bills attached to this hearing that talk about our regulators, the sandbox innovation centers and our regulators, and they're evaluating their own technological prowess. So today we look forward to hearing from our excellent witnesses about fintech and how it innovates innovative financial products and services that consumers want, and what lawmakers should be thinking about to make sure we get that balance between innovation and customer protection just right. And with that, I yield to my friend from Massachusetts, the ranking member of the committee, for an opening statement for 4 minutes.
Thank you, Mr. Chairman, and I want to thank our panel of expert witnesses for coming before the committee and helping us with our work. I also want to recognize Lacey Clay, a former, a continued friend, but a former member here from Missouri, and I want to thank him for his great service to this committee and to Congress in general, and welcome back, my friend. Before we begin discussing fintech and buy now, pay later, I'd like to acknowledge that the House still does not have a speaker. And while I appreciate the relentless drive that the chairman has in continuing with our work, I don't want to pretend that this Congress is functioning, because it is not. It is not. And I think, in a sense, to go about committee work sort of business as usual feels inappropriate and tone deaf to the larger global situation. When you think about the attention we could be spending and focusing on the situation in the Middle East or in Ukraine or other very, very important and urgent matters here in Congress and in our own country, we do not have a speaker. So I would just, I would just suggest to my colleagues that should be job one, and we should not divert any energy or attention away from getting a speaker so this government could begin to function again, because we are not. We are not. And even though there are bills attached to this hearing, they go nowhere without a speaker. And so I just implore my friends on the other side, and I do have friends on the other side, and the chairman is one of them. I just ask that we redouble our efforts and try to get this government back on track, because we are losing faith in the people that we represent. We are losing faith and confidence in our international neighbors. Every day that this Congress, this House of Representatives goes without a speaker, we are diminished in the eyes of the world and the people we have an obligation to represent. We are not representing them today. We don't have a speaker. We are dysfunctional, and we are not fulfilling our oaths of office to those very people who supported us to take these positions. We are in the midst of 2 wars, and as policymakers, we have a responsibility to address the current situation. And while I remain engaged and interested in this topic before us, it pales in comparison to the lives being lost as we speak. For several weeks, we have waited for my friends on the other side of the aisle to move forward with a speaker and intent. Instead, they have played their own internal politics and put that forward and put that ahead of the people that we are here to represent. So I simply urge my colleagues to end this mess and begin governing as we were elected to do so. Now, with respect to the subject matter that is before us, I believe technology does have the potential to lower costs and improve accessibility for those left out of the traditional financial service sector. However, while remaining interested and really believing in the potential of fintech and buy now, pay later products, I want to say that some of these are simply repackaged versions of traditional finance, but packaged in a way to evade laws and regulations under the claims of innovation. So simply put, all fintech and buy now, pay later is not equal. Some of them, I think, are making honest and deliberate efforts to reach the unbanked, to save consumers costs and to reduce the friction in the traditional system. But in November of 2021, as chair of the FinTech Task Force, as the chairman mentioned, I held a hearing that examined fintech liquidity products such as buy now, pay later, earned wage access, and overdraft avoidance products. The emergence of these products raised larger questions about consumers' need for liquidity and whether consumers make enough to afford those necessities. With the rising interest rates that we have in the country now, we're seeing greater problems, greater default rates, and other issues that amplify the problems in this area. So I question whether these products are truly innovative, as industry may claim, or just redesigned for regulatory evasion. So with that, I appreciate your courtesy, Mr. Chairman, and I yield back.
Gentleman yields back.
She is not. Will I had another minute, Tom? Did you do a 4 minute on me, or did you do 5 minutes on me?
Sure, okay. Yeah, let me yield the gentleman from Massachusetts the ranking member's time.
A report from California's Department of Financial Protection and Innovation found that fees averaged on APR of more than 300%. Additionally, I don't believe that consumers should have to pay to access wages that they have already earned in that system. The CFPB has issued guidance that cautions against buy now, pay later products, and several state regulators opened investigation into whether earned wage access and overdraft avoidance companies break state lending laws. And lastly, we're seeing a trend towards fintech players partnering with small online banks to conduct bank-like activity. This raises questions as to whether fintech companies are using bank partnerships to evade state laws. Regulators have raised numerous red flags about the fair lending and consumer protection practices of these banks. So in closing, while consumers do have a true need for liquidity and products that are seemingly lower cost but do not comply with lending laws are not the answer. As policymakers, we should be exploring the true innovative approaches to improving access to credit and financial service products. I look forward to hearing from our witnesses on what they view as innovative approaches, and I yield back. Thank you, Mr. Chairman.
Appreciate the ranking member's opening statement. Today we welcome the testimony of Jody Kelly. Jody Kelly is the Chief Executive Officer of the Electronic Transaction Association. Jimmy Lenz, Dr. Lenz is Director and Master of Engineering in FinTech at Duke University and Managing Principal of the Advanced Research in Financial Services at the Frontier Foundation. Ram Palaniappan is the founder and CEO of EarnIn. Paris Sands, Mr. Sands is Executive Vice President, General Counsel, and Head of Policy and Government Relations at Web Bank. And Matira Spotzer. Ms. Spotzer is the Vice President and Director of Federal Policy at the Center for Responsible Lending. We thank each of you for taking time to be with us this morning. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Mrs. Kelly, we're going to start with you. You're recognized for 5 minutes.
Thank you, and good morning. Chairman Hill, Ranking Member Lynch, and members of the Subcommittee on Digital Assets, Financial Technology, and Inclusion. My name is Jody Kelly, and it is my privilege as CEO of the Electronic Transactions Association to speak with you today about how the payments technology industry is powering the U.S. economy, helping consumers and small businesses, and fostering financial inclusion through the deployment of innovative, secure, and cost-effective products and services. Each year, ETA members process more than $44 trillion in purchases worldwide. The payments infrastructure is sophisticated, secure, and fast, processing hundreds of thousands of transactions a minute and using cutting-edge technology to do so securely. ETA members are committed to providing consumers, including historically underserved Americans, with payments choice and choices that are secure, widely accessible, easy to use, and affordable. I'd like to take a moment just to highlight a few of those products. We're all familiar with credit and debit cards, which are used for the vast majority of transactions in this country. Credit and debit cards are accepted virtually everywhere, are easy to use, and provide zero liability protection for fraudulent transactions. Prepaid products also provide cost-effective and convenient payment options for millions of consumers. And the utility of prepaid cards was never clearer than during the COVID-19 pandemic, when ETA members helped federal and state government agencies deliver billions of dollars in benefits including on prepaid cards. Prepaid cards are also particularly helpful for consumers with limited or no access to other financial services. 9 out of 10 unbanked Americans use prepaid cards for core financial functions, including paying bills or receiving income. And given their utility, numerous federal and state governments deliver benefits through prepaid cards every day. Digital payments are also widely used. Peer-to-peer payment services allow people to quickly make payments to friends and family, usually for free, using apps online or on mobile phones. And digital wallets store payment credentials, such as credit, debit, and prepaid cards, that can also be used to make secure purchases in person or online. There are also digital products for consumers who transact in cash that allow them to order a product online, then take a QR code to a local store and complete the purchase with that cash. And similarly, many P2P solutions allow cash-based consumers to load their P2P account on their mobile phone by presenting cash to a local retailer. And finally, buy now, pay later allows consumers to purchase an item without paying the full price out front, with payments made through typically 4 cost-free installments. These products serve all consumers, including historically underserved consumers, by providing them with an interest-free option to purchase the items they need when they need them. These products are convenient, they are simple, and consumers are adopting them at record pace. In addition to benefiting consumers, these payment options also help small businesses to thrive. And again, this was highlighted during the pandemic when in-person shopping was dramatically reduced and small businesses were at risk. The payments industry helps small businesses adapt by establishing global online presences, accepting payments online, or by tapping to pay, which allowed many small businesses to remain in business. And that innovation continues as new technology now helps merchants receive funds quicker and access much needed capital. I'd like to conclude today by discussing how ETA and policymakers can continue to work together to ensure high quality and affordable payments are accessible for all consumers. But first, I think it's important to note that the payments and fintech industry is already subject to a comprehensive legal and regulatory framework, which has been supplemented through robust self-regulatory efforts, including security standards. At ETA, we support policies that provide certainty, engender trust, protect consumers, and encourage innovation. To that end, we encourage policymakers to advance policies that are technology neutral, principles-based, and allow for industry-led standards, and use the same risk, same regulation framework. As the industry continues to evolve, it is imperative that the policy framework protects consumers while encouraging continued progress. At ETA, we're proud to represent the payments technology industry. On behalf of the industry, I want to thank you for the opportunity to speak with you today, and I look forward to answering any questions you may have.
Thank you, Mrs. Kelly, for your testimony. Dr. Lynch, you're now recognized for 5 minutes for your oral remarks.
First, let me thank you all for having me here. Chairman Hill, Mr. Lynch, it's a pleasure really to be with such an esteemed group, and my colleagues up here. It's great to have this opportunity. So, as you mentioned in your opening comments, I'm currently at Duke University. I lead the Master of Engineering in Financial Technology. I also have another role where I lead a team in advanced research and financial services for Frontier Foundry, and that company works directly in industry. My roots in industry go back about 35 years. I actually checked FINRA, my broker check, to see when I was first licensed, 1985, which I'm guessing is before a lot of you were born. But I've been in financial services that long, and my career in financial services has been defined by innovation. When I started, there were no laptops or computers on desks. Exchanges were still open outcry. There was not a lot of technology, but it was coming. And that's what's kind of brought me to where I am today. I've seen innovation do so many things to the industry, to finance in general. And what that's meant for consumers is huge. So when I started, spreads on stocks were 12.5 cents an eighth, often 25 cents, 50 cents. Now, typically a penny. Everything is transparent. You can do everything online. And how did that come about? Online trading, online banking, online access. Well, innovation. And sometimes innovation comes from areas where people don't expect. So I know that most people are thinking, when they think innovation, they think the big players, big banks, big brokerage firms. First bank to put accounts online, Knoxville, Tennessee. Small community bank. First bank to give folks access to their accounts, Presidential, and then Stanford Federal. Small places, small players. Mr. Hill, you mentioned ATMs. It wasn't invented by a big bank. It was a Scottish engineer. Sold it to a big bank. Those kinds of developments are directly beneficial to consumers at the end of the day. And while we think about innovation in terms of big financial institutions, at the end of the day, these trickle down to consumers. They mean access, they mean price advantage, and they mean transparency. Are there risks involved? Absolutely. I've spent my career basically looking at risks. I was a trader on the electronic and algorithmic side. I ran a trade desk, ran a brokerage firm, was chief risk officer of one of the largest brokerage firms in America, along with the chief credit officer. Did I care about risk and did I think about it? Every single minute of every single day. But risk is what we do. It is inherent to the business. It's inherent to what I think is the financial system in the United States. With innovation comes that, but you don't get that trade-off. You can't have no-risk situations and still move ahead. Everybody needs to take a little bit of risk. Needs to be measured, needs to be quantified, needs to be well understood. But remember, when you eliminate risk from any equation, you also eliminate reward. There's a reason we call the risk-free rate of return the lowest rate you can get. And I think sometimes that's forgotten. The other thing I think that sometimes doesn't boil up is the fact that innovation doesn't happen in a vacuum. Sometimes there are failures, and it actually happens more often than not. In fact, one of the things I tell my colleagues and my students, if you're not failing on a pretty regular basis, you're not trying hard enough. And so I think as we go forward, as we think about innovation, in particular in financial services, we need to be very mindful that that doesn't come with some trade-offs. Are there going to be risks present? Absolutely. Should they be well understood? Absolutely. But options are always a positive thing, and more options are better. Thank you very much for the time.
Thank you very much, Dr. Lentz. Mr. Palaniappan, you have 5 minutes for your oral remarks. Thank you for being here.
Chairman Hill, Ranking Member Lynch, and members of the subcommittee, thank you for inviting me to testify today on modernizing financial services through innovation and competition. My name is Ram Palaniappan. I'm CEO and founder of Earnin, a company focused on improving the financial health of our customers by giving them more control and choice over their finances. Our primary product, known as Earned Wage Access, or EWA, addresses the problems caused by the archaic and rigid system of fixed paydays. 2/3 of our country lives paycheck to paycheck, and much of their lives revolve around waiting for payday. With EWA, workers can access the money that they have already earned without waiting for payday. Around 2 million people use our product. People who work at retail, teachers, nurses, and even government employees, such as TSA agents and over 100 congressional staffers. Today, there's also several other companies that offer similar EWA products. I'd like to tell you about how Earnin started. I didn't set out with the intent to start a company. I was working at another company, and there I heard that some of my employees were running into overdrafts. And I spoke with one of them. I was surprised because I thought we were paying everybody well, so I spoke with one of them. The problem that she had was she needed money the next day, couldn't wait till the following payday, was already halfway through the week. And so I said, we'll pay her for the days that she had already worked, and I couldn't make the payroll system do that. And so I gave her the money that she had already earned, and we settled it on payday. And I continued doing this in person for a handful of people for about 4 years. And then I left the company, and they wanted to know if I'd still do it for them. And I didn't mind doing it. These were people who I'd seen in the office for years. And so at first, I did this over Instant Messenger. And then that was not very convenient, so I built a web form. And then when I had this web page up, then people who I didn't know tried to use the product, and I did it for them as well. And what I realized was that when you give someone access to the money that they've already earned, when they need it, their life is much simpler. They're paying all their bills. The bills are not piled up on payday with late fees. There's no more overdrafts, no more expensive loans. And that's when I realized that if I didn't try to make this into a product, I'd always feel bad about myself. We now do this at scale. Every month, over 1 million people use Earnin to pay their rent on time, to buy gas to get to work, and to buy groceries. And by accessing their wages when they need it, our customers are avoiding over $1 billion a year in overdraft fees. The benefits of EWA are not just financial. I met with one of our customers in Columbus, Ohio. She works at a hospital, and her daughter has a passion for dance. And she was telling me that she needs to pay for the dance classes up front at the beginning of the month. And if not for our app, she wouldn't have been able to do that. And so to me, it's amazing that through our app, her daughter is able to pursue her passion for dance and participate in dance competitions. If we want more financial access, if we want more financial inclusion, then we need new financial products. And for new financial products to work, we need innovation and the right regulatory frameworks for them. EWA is one of the innovations that provides a great option for people who do not have any good ones, but it does not fit well into existing regulatory frameworks. The CFPB, under Director Cordray, exempted EWA from the payday rule, and in recent budget proposals, the Biden Treasury Department has said that on-demand pay arrangements, a common term for earned wage access, should not be considered loans for tax purposes. We agree and think EWA needs its own regulatory framework. EWA solves problems in a unique way with much-needed consumer protections. Last year, Treasury Secretary Yellen spoke about how the delays in our payroll system harm those with lower incomes. EWA helps solve that. But if we don't create new legislation and regulations, then we are left with the same products we already have. And that means we are satisfied with the status quo and we're comfortable with the amount of inequality we have. I believe we can do better, and I think we all want that. And that's why we need legislation and regulation that preserves and promotes innovation and consumer choice. I'd like to thank Congressman Stile for the discussion draft and look forward to working with all members to find solutions that help consumers. Mr. Chairman, Ranking Member, members of the subcommittee, thank you for the opportunity to testify today. I look forward to answering your questions.
Thank you for your testimony. Mr. Sands, you're now recognized for 5 minutes to give your oral presentation.
Thank you. Chairman Hill, Ranking Member Lynch, and members of the subcommittee, I'm honored to appear before the subcommittee today on behalf of WebBank to discuss how responsible bank partnerships like WebBank's drive innovation, enhance inclusion for underserved consumers, and support compliance with applicable laws and regs. We also wish to express support for innovative BNPL and EWA products and efforts to regulate them as non-credit products. My name is Per Sands. I'm the EVP General Counsel and Head of Policy at WebBank. WebBank has the longest track record of successfully overseeing third-party lending programs through bank partnerships and has originated and funded over $180 billion in consumer and commercial loan products. The bank provides its credit products through the platforms of its non-bank strategic partners, including well-recognized technology companies like PayPal, Intuit, Shopify, and Toast. Based on the bank's experience as a pioneer in the industry, we believe that bank fintech partnerships can unlock the greatest strengths of each participant, yielding a sum greater than its parts. Fintech companies develop amazing technology platforms that deliver minimal friction, state-of-the-art customer experiences, serving customers on their mobile phones and online where they want to transact. These technologies provide the ability to scale quickly and reduce costs, but banks often struggle to develop them on their own. Banks like WebBank have deep expertise in financial product design, regulatory compliance, and oversight. When these capabilities are combined, they enable the parties to bring innovative and valuable financial products to market efficiently and at scale, while ensuring legal and regulatory compliance. At WebBank, we believe the best way to operate these partnerships relies on 3 key pillars. The first, the bank must engage in rigorous due diligence and risk assessments of the fintech partner, upfront and on an ongoing basis, commensurate with the applicable risks of the partner in the program. Second, the bank must carefully structure its agreements with the fintechs to limit the bank's exposure and to ensure that the bank has the rights it needs to control the program effectively and to oversee its lending programs, including control of the credit policy, marketing, and customer-facing materials. Third, the bank must apply ongoing supervision and oversight across all aspects of third-party lending programs. Banks should require their fintech partners to adopt and maintain bank-approved compliance management systems and to regularly test, audit, and report on them. WebBank's application of these core pillars has enabled us to bring valuable consumer products to market in compliance with applicable laws and regs, subjecting our fintech partners to the supervision and oversight of the bank and its regulators. But some stakeholders would have this subcommittee believe that bank partnerships are inherently problematic because they present the theoretical possibility of supporting high APR consumer products. They point to rare exceptions of banks supporting high APR programs through bank partnerships to claim the bank partnership model itself is problematic, ignoring that most high APR programs come from other entities, not bank partnerships. Moreover, these stakeholders take the position that if a non-bank has the predominant economic interest in a bank-originated loan, that the partnership is a rent-a-bank and the non-bank must be treated as the lender under state law. This position is illogical and completely inconsistent with Supreme Court precedent and the realities of the secondary market. For example, if a bank originated a 5-year installment loan and sold it to a credit fund in the first year, the conclusion that the purchaser is the true lender, subject to the myriad state laws in which borrowers reside, would bring the entire secondary market for such a loan to a grinding halt. These stakeholders attempt to obscure the reality that the bank partnership model is a neutral one, by which banks and fintechs can work together to leverage what they each do best to drive innovation, inclusion, and compliance while operating within the regulatory perimeter. WebBank provides the strongest counterexample to these claims by providing consumers with financial products that are innovative, inclusive, fairly priced, and comply with all applicable laws and regs. For all these reasons, state and federal lawmakers should be wary to attack bank partnerships lest they throw the baby out with the bathwater. Laws affecting bank partnerships that are intended to keep out predatory programs have been over-inclusive and have the effect of keeping out responsible programs as well. Accordingly, we ask members of this subcommittee to support efforts to create greater legal certainty regarding the treatment of loans originated by banks and bank partnerships. We ask Congress to support a more reasonable and practical framework than the predominant economic interest test to determine when the bank is the true lender and when inconsistent state laws are preempted by federal banking laws. Finally, WebBank cautions this subcommittee against adopting a one-size-fits-all approach to regulating BNPL and EWA products that conflates them with traditional credit products. To do so risks overregulation that is not appropriate for such non-credit products. The appropriate balance between financial innovation and regulation lies in a tailored regulatory framework based on the provider's activities and commensurate with the actual risks associated with such products. Thank you for the opportunity to testify today, and I look forward to answering your questions.
We appreciate your testimony. Ms. Spotzer, you're now recognized for 5 minutes for your oral presentation.
Well, first of all, good morning, everybody. On behalf of the Center for Responsible Lending, I'd like to thank you, Chairman Hill, Ranking Member Lynch, and members of the committee for the opportunity to testify today. 2 words really stick out in the title of this hearing, and that is innovation and competition. And the core of my testimony is going to focus on those 2 words and talk about, most importantly, why it's important that we remember actually what those words mean and why they matter. And so I'm going to start with, first of all, why they matter, right? We believe in innovation in the financial services market, and the Center for Responsible Lending does as well. But we believe in it because done correctly, innovation improves lender efficiency. And by improving efficiency, lenders are better able to market a product at a more affordable cost to consumers. So the goal here in innovation is to expand access by competing on price. The reason why that matters in this conversation in particular is that some of the regulatory exceptions that are being asked to be made today are to, in fact, not have to compete on price. So we are talking about products that are asking that they not be held accountable to the same disclosure obligations that other financial institutions, credit unions, community banks across this country are required to do. And the rationale behind that is that somehow these products are different. So let's take an example, and since I have a very short amount of time, I'm only going to give one example. But let's take a product like early wage access, right? And the notion is, well, you get your wages early, right? But these third-party products are not connected to the employer. The employer is actually not transmitting your pay. The third party is in fact using their own financial, their own cash that they have available, and they are submitting it to the consumer. The consumer, the company, does not actually go to your employer to deduct that amount from your paycheck. So it's not an employer payroll deduction, and the recourse is not against the employer. The recourse is against you and your bank account. That's a loan. The reason why it's a loan is this. We have all been working in the financial services sector for a number of years, and I gotta tell you, anytime I advance cash to someone with the expectation that they repay that capital to me, it is a fundamental business proposition that I look at their ability to repay that based on their future income. That's called underwriting. It's a really important component of underwriting that every single financial institution does. So you are always repaying a loan based on your future earned income. And I am always structuring the repayment of your loan based on when I anticipate those wages will come. So what we have here is not a fundamental distinction of the characteristics of the product. We have a really interesting way to explain a product that already exists. But, you know, I'm kind of from a small town, and so we have these kind of traditional sayings, and one of them is if it looks like a duck, it swims like a duck, and it quacks like a duck, it's probably a duck. Buy now, pay later, early wage access, they look at and function like credit. They look and function and act like capital and loans. They should be regulated as such. And here's why this matters on the second end about competition. You know, I talked about the fact that I'm here from the Center for Responsible Lending, but we're also an affiliate of a financial institution, self-help, right? We have self-help credit union and self-help federal credit union. The reason why this matters so much is because this committee is also inherently concerned about the brick and mortar financial institutions in your district that work with your constituents to actively report credit histories from payments and to push them into assets and develop long-term relationships with them that lead to wealth-producing assets. They're all required to meet the same disclosure obligations that these institutions are somehow representing they should not be subject to. But that's not competition. That is, in fact, inherently anti-competitive. I say to you, we have no aversion to buy now, pay later products and early wage access products, anything that people want to do with respect to these products, as long as they are required to be able to produce the same information about their costs, and as long as they compete under the same characteristics that every financial institution in this country should compete on, and that's price. Voluntary tips and monthly subscriptions disguised as excuses other than actually charging the cost of credit are not competing on price. Thank you.
Thank you for your testimony. Appreciate the entire panel's participation. Chair now recognizes himself for 5 minutes for questioning. In my opening remarks, I talked about community banks in my home state of Arkansas partnering with fintech startups to be on the cutting edge of technology and meet consumer demand. We're blessed in Little Rock to have our Venture Center that's been open now 11 years, and our fintech partnership with FIS, the publicly traded company there, has Little Rock as the top of its innovation hub, looking for fintech solutions that they can offer to banks for both internal compliance, cost reduction, as well as customer acquisition, customer service aspects of it. And it's been impressive over the last decade to watch their innovation and the expansion of what they're doing. According to the McKinsey company, when you look at the top 100 banks by asset size, 80% of them have now partnered with at least one fintech company over the years on that same sort of approach, internal improvement and reduction of cost or customer acquisition or service. Mr. Sands, why is it that when only a few years ago that we viewed this fintech bank situation as disruption and the fintech companies were testifying they were going to put commercial traditional banks out of business, that we now see a lot more collaboration? Can you reflect on that change over the past few years?
Yes, and thank you for your question, Mr. Chairman. I would say that over the last few years, many banks have come to the realization that if you can't beat them, join them. The DNA of banks and fintech companies are very different. Banks are focused on risk management, regulatory oversight. Fintech companies, their focus is on the customer experience, minimal friction, ease of use, really essentially bringing, if you will, Apple-like design principles to financial services and products. These are technologies that are difficult for many banks to develop internally, both because they don't have the DNA, if you will, and often because they don't have the resources to do it. So
Let me interrupt you there because that brings up a good point, I think, about traditional banking and their access and use of big data to enhance their own customer database, their own geographic data knowledge. Would you say that that's really helped banks reach out to more customers and expand product availability to people that have little or no credit history because the traditional banks just don't have access to the data? Have you blended that in what you're doing with the fintechs?
yes, absolutely. Although banks certainly have developed their own internal technological capabilities, certain technologies definitely have been outside of their focus. I'll give you one example. WebBank established a partnership with a company called PedalCard. Pedal had developed cutting-edge technology with respect to cash flow underwriting, pursuant to which they could ingest bank statement transactional history, consumer permissioned information, and with that, they could develop a risk score for someone who was no file, thin file, that could be used to underwrite them either alone or in conjunction with traditional scores. We've partnered with them since 2018, and we've been very successful in being able to provide introductory credit cards to credit invisible consumers who likely would have been declined by other financial institutions.
That's helpful. Just continuing with that theme, since you partner with these companies and you provide that bank compliance focus really to Ms. Spotzer's concept about everybody playing by the same rules effectively. WebBank has a high standard of compliance. So what do you think recently on the third-party risk management guidelines that have been published by the interagency?
Yes, thank you for the question. I would tell you that our view is that we generally agree with the sentiments and thoughts expressed by Governor Bowman. Although we think that some of the principles put forth are helpful, it is a one-size-fits-all recipe that is being provided that doesn't provide sufficient tailored expectations for smaller institutions. When we initially saw the guidance at WebBank, we held it up to ourselves and felt comfortable that we live up to those principles, but we're a bank that has been focused exclusively on managing fintech partnerships for over 25 years with 250 people dedicated to it. As I look at that guidance and think about other banks who would want to begin to leverage relationships with fintechs, I think it could be very daunting in terms of the resources.
In my time remaining, if you could respond in writing just how you tailor that scope, I think, so that we could have some feel for that in the committee, that'd be very helpful. That concludes my time, and I turn to my good friend, the ranking member of the committee, for his 5 minutes of questions.
Thank you, Mr. Chairman. Ms. Spotstra, you highlight, I think very well, the conflict between the business practices of credit unions and traditional small banks and what they have to do in order to report and track the creditworthiness and loan performance of their products versus the carve-out that's being urged by folks in fintech and buy now, pay later. Can you talk about, there's a generational change going on here where a lot of young people, my two girls, I don't think they've been in a bank ever. They do everything on their phone, right? They've got that iPhone, and so they are much more likely to gravitate towards this product. And I think in a way that's what the industry is doing here. They're sort of following customer preferences. But there is a trap I mean, we've seen a spike in delinquency rates among buy now, pay later customers. That's worrisome, especially in recent months where interest rates are going up. And I know that buy now, pay later, many of them don't charge interest rates. They have different ways of monetizing this. However, there's pressure in the general economy, so people are borrowing more. And so the default rates and delinquency rates among buy now, pay laters customers is far higher than those who are non-borrowers in that space. And I just wonder if you could talk about the trap that young people or anyone using that product might fall into.
Sure. Hopefully the mic is on. So the biggest issue here is that, these products are marketed as being interest-free and free. And so as a consumer, right, the first thing I think is that really means that it is free. And then when you go into the weeds of looking at the product, there's a service fee, or something else that is associated with it. And so the costs themselves are not upfront. So you're right, sir. I think, to the extent that there's a technological advantage, you have an app, although there are very few financial institutions in the United States right now that do not have apps. But to the extent that you have that, there is some familiarity and ease. But what we are seeing is the most significant point here is that we are not accurately reflecting the costs of these products. And because of that, we do have an increase in delinquencies because individuals are in fact not fully aware of the costs up front, whereas financial institutions, traditional brick and mortar, do have an obligation to disclose that. Now, I want to be clear, I believe that these institutions have that same obligation to disclose it. That is a regulatory matter that the Consumer Financial Protection Bureau will hopefully provide some guidance on. But it is imperative that people actually disclose the full cost of credit.
Right, and simply looking at that one payment, that monthly payment, does not illustrate or give a picture of the true cost of that overall purchase, right?
Yeah. Not if you're charging a service fee or a late fee that comes on top of that, and there is an expectation. One of the issues here is that these are not one-and-done products. Even by their own analysis, there was a report from FTI Consulting that was convened by Earnin and a couple of other organizations. They are saying that the consumers use these products every 2 weeks. We remember a product that looked a little bit like that, right? And so it's not just the $100 that you borrowed and the $10 fee there, and then the expedited processing fee, none of which are disclosed as actually being the cost of credit, but it's the fact that you're going to do that 3 or 4 times. And because I have access to your bank account, there's a high probability, since I'm saying that my product is being used to cover overdrafts, that I in fact am overdrafting your account in that process. So now I need to borrow even more money. And so one of the things that we want to be clear here, and why we're saying not again that these products should be taken out of the market, but that they should be upfront about their disclosures, is that consumers have the right to know what the full cost is and understand the risks that they are taking by taking out one of these products.
That's great. What are some of the standards that you'd like to see applied to the buy now, pay later space and some of these, arguably innovative platforms that are offering different ways, although not fully transparent, to consumers on financing their debt?
I'd like them to abide by the existing law, which is the Truth in Lending Act and the Credit Card Act, to the extent that their products actually meet those obligations. And that means that they would be upfront about the costs of their products.
That's great. Thank you. I yield back.
Gentleman yields back. The gentleman from Ohio, the vice chairman of the FinTech Digital Asset Subcommittee, Mr. Davidson, is recognized for 5 minutes.
I thank the chairman, and I think the witnesses really appreciate your expertise and your time and travel here to help educate us and inform us on policy. It is a dynamic time in our financial markets, and FinTech is really, making people wrestle with these things. Even as I listen to you all in your statements, have some overlap in agreement and some healthy disagreement. It is important for us to understand this because we have to adapt as well to make sure that our laws stay relevant and functional so that our markets do that for our consumers. So I just think it's great that we have this subcommittee. It took a while for the Financial Services Committee to get to here. But one of the constants has been, go back to the Bill of Rights, the Fourth Amendment, the right to privacy. So much of our data is collected through the payment system, through financial technology, going back to the whole Bank Secrecy Act and the third-party doctrine. It's all been established with financials. I had a conversation recently and said, well, why would a business still accept cash? And there are a host of reasons, but one of my answers was maybe they don't want to spy on their customers or facilitate spying by others on their customers. So recently this week, the Consumer Financial Protection Bureau, or about a week ago, introduced their 1033 privacy rule. Lots of comments coming on it. People have digested about 300 pages and gone through it. And Mrs. Kelly, I just wonder how you could think about payment privacy as we work towards maybe a Payment Privacy Act.
Yes, Congressman Davidson, thank you for that question. So, we represent the payments industry, and there is no issue that is more top of mind for the payments industry than security and trust, right? Consumers have to know that their data is secure. They have to know that they can trust the system, and they have to know that their privacy remains intact. And that's exactly why the
Could you pull the microphone up a little bit? Yeah, because you're drifting off there. Thank you. Thank you so much.
All right, is that better? Terrific. So as we think about the issues of data security, privacy, and trust as an industry, I was saying that's exactly why the industry has devoted billions and billions of dollars to security to ensure.
Yeah, it has to be secure, but I mean, obviously you collect information about the consumer to know this is who they say they are, they have the credit that they have. And I think the concern is what happens with that information afterwards. There's a big market for it. How do you protect it and recognize kind of the property right that consumers have it? And I think that's the fundamental question. So I look forward to collaborating with you, your sector, frankly, people broadly, because I think this is something where the CFPB, to me, is focusing on one of the core issues our consumers care about, which is their data. And people are monetizing it in a lot of ways, and frankly, the government's kind of exploiting it some. So I look forward to wrestling with that. I think that's one of the most important topics for our committee to resolve. Mr. Sands, in your testimony, you lay out some of how poorly devised state laws have created legal uncertainty regarding whether bank-originated loans will remain enforceable on their original terms after they're sold to non-bank entities. Obviously, the structured credit market is a very big part of our financial markets. Can you relay how this legal uncertainty is impacting consumers in our markets?
Absolutely. I would tell you, Congressman, that it's a repeat of what we saw after the Madden versus Midland case in the Second Circuit. When that case came out, it raised legal uncertainty regarding the enforceability of bank-originated loans at APRs above certain state rate caps in Vermont, New York, and Connecticut in the hands of non-bank purchasers. The result was that the secondary market seized up and those loans were no longer originated. The impact was very clear. It was set forth in a study that I included in my written testimony, and it showed that whereas consumers before the Madden decision, say at FICO's below 640, were able to receive capital, after the decision, those loans dried up entirely. And when you looked outside the Second Circuit, you saw availability increasing for that same risk profile population. The same legal uncertainty is being created in states like Illinois, New Mexico, Maine, and others who are passing laws that basically say that if the non-bank in a partnership has the predominant economic interest in a bank-originated loan, that the non-bank itself is the lender, subject to state laws.
And it changes the whole terms of the deal, so how do you know you've really got a deal? It essentially kills the market, right?
Yeah, I completely agree, sir. I mean, this is a one variable outcome determinative test. Who enjoys most of the economics in the underlying loan? It's completely inconsistent with the secondary market. Banks originate loans and sell them all day long. That's how we can make more capital available.
Thank you. My time's unfortunately expired, and I yield back.
Gentleman yields back. The gentleman from Illinois, Mr. Caston's recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you all for being here. Just before we start, and I do want to spend most of my time talking about your expertise, which I appreciate you sharing us today, I just want to chat with you all for a moment as Americans. We are less than 3 years after January 6th. After the House was attacked, we walked back to the House floor, we walked through the broken glass on the floor, we walked past cots with National Guard officials who were sleeping in shifts so they could continue to protect us. And I went up and I sat with Mr. Hill up in the gallery and watched the debate start on whether or not we were going to overturn the Arizona election results. And I watched the majority of the Republican caucus vote to continue the work that the insurrectionists tried to start. And number one, I want to thank Mr. Hill for your vote that day and not voting to overturn the election. I want to acknowledge that the chairman of this committee also did not. It should not be exceptional or praiseworthy to defend our democracy, but I understand the courage that takes in today's Republican Party. And I say that because we are moments from going to the floor and deciding whether to elect as Speaker someone who not only voted to overturn the election, but wrote the legal framework that his colleagues said empowered them to do the same. And I say that because democracy only survives if we defend it. I hope to be able to tell you at the end of the day that there is robust bipartisan support for the peaceful transfer of power and democracy, and I fear that I'm not going to be able to. Because everything we're talking about today is predicated on that continuing. I move to EWA. Mr. Planibiat, I'm going to pronounce your name wrong, I apologize, Palaniapialan. Nice to see you again, and I don't want to make you the poster child for your whole industry, but I'm hoping you can educate us a little bit. As I recall from our conversation before, your payment model, you have a no cost, but people can offer to pay tips if they like the service, and then you have a separate cost where people pay $1.99 to $3.99 if they want. I see you nodding your head, so hopefully I've got that about right. Is $3.99 the maximum fee if they do that?
That's correct.
Okay, and what? Again, I don't know if you're representative of the industry, but what percentage of your customers opt for the immediate payment versus the delayed payment?
Thank you for the question, and I can speak about our numbers. I think the industry might be similar.
Just an estimate, because I want to get through, because I'm trying to educate myself on this. I don't mean to be a leading question.
So we allow what we call tips, voluntary payments, on all transactions. Over half of our transactions do not have a tip, and the average tip is $1.45. And then on the lightning speed, which is the wire-like service, that's $1.99 to $3.99. The usage varies. On the weekends, it's higher because ACH shuts down.
Okay, but overall, about 50% on an annual basis, is that?
It could be a little bit higher than 50%.
Okay. And what is the average amount that people are taking out when they're doing that expedited payment? I see that you have a cap of $750, but what's the average that people are taking that they have to pay that $1.99 to $3.99 on?
So the $1.99 is a choice. They can also get it same day at no cost without the lightning speed because we use same day.
Yeah,
ACH.
I'm just talking about the lightning speed piece.
The average for across all transactions is about $85 a transaction.
Okay. And you may not want to answer this. I'm sure you're a private company, but what is the return on equity you have to hit in order to make sure that you have the capital necessary to keep your business running?
I'm not exactly sure how you calculate return on equity.
Well, what I'm saying is you're providing effectively a working capital revolver, right? And your ability to access the capital to fund that and to grow is going to be contingent on delivering some acceptable return to your capital providers. So what is the number you have to hit, whether through tips, through $1.99, through $3.99, over the range? What do you have to manage your business to?
We don't have any thresholds that we are required to hit. I think we're trying to make a business that's sustainable. It's sort of interesting, like how the whole pricing model came about. If you'd let me talk about it.
Well, I'm again, I don't. If you're uncomfortable, what I'm trying to understand, and maybe let me sort of maybe get to the punchline and work backwards. I admire what you're doing, and I'm trying to understand how this all sits together. But there is the question that I think Ms. Spotzer, raised of. At some point, where is the bright line between a lending product and an act of charity and something that doesn't need to be covered? And of course, in this hearing, we've got a bill that's been notified that would exempt the EWA industry from the Truth in Lending Act. Maybe let me call the question. Do you support the EWA not being subject to the Truth in Lending Act?
He can respond to that question in writing.
Okay.
Promptly.
Ms. Spotzer, I'd welcome your thoughts on that question as well, because I am trying to understand to the degree this is a loan and how we think about that.
The gentleman's time has expired. Ms. Houchin is recognized for 5 minutes.
Thank you, Chairman Hill and Ranking Member Lynch. Thank you to the witnesses for testifying today. Since I became a member of this committee in January, one of my top priorities has been to ensure that everyday Americans, including those who live in my district in southern Indiana, have flexibility and choice when it comes to planning for their own financial futures and for their day-to-day financial activities. Innovation in fintech has been instrumental in helping to bring about more opportunities for all Americans, from delivering products to underserved communities to providing flexibility with payroll and payments. Clearly, financial technology has already changed the way people interact with their banks and the financial sector. While many Americans access their bank accounts online and invest with their smartphones, fintechs have also made it possible to make larger purchases through flexible payment arrangements, which can allow an employee to access earned wages without waiting until payday arrives. With all the benefits that financial technology has to offer, I think we need to ensure that our regulatory environment ultimately helps people access some of these financial services products and then have the tools they need to invest and save on their own terms. Mr. Sands, WebBank has entered into a partnership in which the bank provides credit access to individuals who lack established credit history, an example being small business loans. Could you walk us through why a bank fintech partnership would be critical to offering these types of products?
Yes, absolutely, and thank you for the question. We have entered into various partnerships that take advantage of transactional data, as you indicated, some on the small business side, some on the consumer side. I mentioned the consumer one before. It's one of a number, but the relationship with Petal stands out in that Petal has developed leading edge cash flow underwriting technology that really provides incredible real-time visibility into the financial condition of a consumer. You can see the income that they're bringing in, other amounts coming in. You can see how much they're spending, how much they're saving, and these are categorized in a way that is not getting into the nitty-gritty or favoring a purchase at one kind of a store versus another. But with that, you can essentially effectively underwrite folks with thin file or no file. Similarly, on the small business side, we've been able to achieve similar results with PayPal, where we have flexible payment loans that are based on the transactional history that we see flowing through PayPal's closed-loop system. And so we're seeing the revenue that's coming in, and those provide really powerful insights, especially since COVID, given that credit scores are a lagging indicator and they've been really muddied by the stimulus.
Thank you. And Mr. Palaniapan, families working paycheck to paycheck currently are bound by a 2 to 4 week pay cycle, where there could be real-life factors and unexpected medical bills where they can't wait for payday. We know that a study conducted by Branch, approximately 48% of hourly employees have no savings, 83% have less than $500 saved. So the earned wage access products can help consumers pay bills on time and avoid overdraft fees. Will you describe the additional benefits that come with giving access to consumers depending on that traditional 2 to 4 week wait, and how these products offered by EarnIn allow consumers to manage their finances in a way that meets their own needs, paying bills before payday?
Sure. And like on the antiquated payroll system and people waiting 2 to 4 weeks, it actually wasn't always this way. Previously, people used to get paid every day after they worked. And really nothing else in our life works in a 2-week batch. I mean, just imagine if Google said, give me all of your search queries, and then in 2 weeks I'll give you the results. Nobody would use Google. That's the payroll system we're forcing everybody to live with, and it doesn't need to be that way because the technology exists to run payroll much faster for people. In terms of benefits, like I told you about the $1 billion in overdraft fees that our customers avoid every year because they can access their wages when they need it, to pay bills on time, to pay rent, to buy gas, to buy groceries. There's also like lots of benefits that are not financial. We've heard from lots of customers who, after years, have celebrated their birthday on their birthday and not on payday. People who have gone to the dentist when their tooth aches and not put it away till payday because they could afford to go to the dentist. Heard from a customer whose son she sent on a field trip because she could access EarnIn, and if not for EarnIn, would not have gone on a field trip. So I think there's all of these ways in which people's lives are being held back because we lock their pay in the pay cycle.
Thank you. And then finally, with the remaining time I have, Ms. Kelly, what about the buy now, pay later products? What options would be available to these consumers if those products weren't available? Who's using these, and why are the flexible payment arrangements so popular?
Yeah. So consumers across the board are using them. It's an incredibly popular product, and for good reason, right? It gives consumers choice, flexibility, optionality that they wouldn't have without this product. And similar to just what we heard, sometimes people need to make a purchase when it's not convenient for their pay cycle for other reasons. Buy Now, Pay Later allows them to do that, paying in what is in fact typically free over 4 installments, which just provides choice to consumers that's important that they wouldn't have otherwise.
Thank you, Mr. Chairman. I yield back.
Thank the gentlewoman for yielding back. Mr. Nichols recognized for 5 minutes.
Thank you, Mr. Chairman. It's great to be back here in the committee room getting to work. I'm excited about the work we're doing here in a bipartisan way, the digital assets market structure bill, the stablecoin bill. I'm ready to start working together to improve those bills and get things moving again on the floor of the House. But today we're here to talk about fintech, and fintech companies play a crucial role in driving economic growth and financial inclusion. We need to strike a balance that encourages innovation while ensuring robust consumer protections, as this will not only boost our economy, but also provide better access to the financial system for marginalized communities. It's our responsibility to foster an environment where fintechs can thrive, creating jobs and expanding access to affordable financial services, while never losing sight of the need to shield consumers from potential risks. My first question, Mr. Polanapian, can you please explain the regulatory structure, if there even is one, for earned wage access products?
Thank you for that question. So in 2017, the CFPB under Director Cordray exempted EWA from the payday rule. And despite being exempt from the payday rule, there's a number of other regulations that we adhere to. There's UDAP, GLBA, and then privacy things like the CCPA. There's also Nevada's passed a law that sort of establishes a framework for earned wage access, SB 290. Missouri's also passed another law that has a framework for earned wage access, SB 103.
And so what's the need for new legislation?
So I think it provides clarity, and I think with the right consumer protections, and earned wage access has a number of new and much needed consumer protections. The product is always available to customers at no cost. It's a non-recourse product, so there is no collections, and there are no penalties, there's no late fees, it does not impact your credit score. I think we want to get those protections in the law so that the consumers can continue to access the product with confidence.
I've heard a lot of concerns about earned wage access products locking people into a cycle of debt. Can you please explain what happens if a consumer doesn't repay their funds?
The service is simply paused. And then if they want to use it again, they call us up and they make us whole, and then they can use the product again. There are no late fees. There is no interest accruing. There is no impact on their credit score.
Thank you very much. Again, charges or interest, there are none that have to be repaid by the consumers.
That is correct.
Mr. Sands, next question to you. Can you explain the role of technology and innovation underwriting approaches such as cash flow underwriting in promoting financial inclusion and providing credit to thin file or no file customers?
Yes, happy to, and thank you for the question. This has been an answer that I've presented a couple of times today, but to maybe expand more generally beyond our relationship with Petal, I would tell you that I think what many fintech players have realized is that traditional credit scores don't provide the insight, the real-time insight needed to effectively underwrite consumers, small businesses, et cetera. And attempts have been made to tap into real-time information, including bank statement information, credit card processing information, other receivables flow information, to be able to see the actual real-time financial health of a potential borrower. That's incredibly powerful information, especially for people who are new to credit, low and moderate income individuals who have thin files or no file. If a traditional approach were applied to them, you would look at the FICO, and if they're below 640, the answer would be no. If you look at their bank statement information and you can see that they have reasonable income coming in, they're spending at reasonable levels, they're net savers, for example, then they're a reasonable bet. And one great thing about this information is that it's actually been studied and largely validated by FinReg Lab, run by Melissa Coity, She looked at about 6 different firms that use cash flow underwriting in their business and found that these cash flow underwriting models are predictive, they're inclusive, they are helping people who otherwise have trouble accessing credit, and there's no indication that they present any proxy or fair lending problems of any kind.
You know, my goal is how can we expand credit, especially to marginalized communities, communities of color. That's my goal. But in your experience, what distinguishes responsible bank partnerships from predatory lending practices, and how can policymakers differentiate between the two when we're crafting laws and regulations?
Yes, thank you. I would tell you that responsible bank partnerships are ones where the bank has control of the program, oversees the program carefully, controls the credit policy, the marketing materials, requires compliance management systems and audits them, and offers products that comply with the existing guidance regarding what constitute non-predatory products. Predatory products, on the other hand, are holistically problematic in terms of their repayment rates, fee harvesting, repeat usage that indicates that it's not healthy reborrowing, but it's a debt trap.
I yield back.
I thank the gentleman from North Carolina for yielding back, and now the gentleman from the inspiration for the FinTech flyover in Lincoln, Nebraska, Mr. Flood, for 5 minutes.
Thank you to the good chairman from the state of Arkansas. Mr. Sands, according to a study conducted in 2021, banks that partner with fintechs average 2.5 partnerships per institution. In your view, why are banks partnering with fintechs?
Thank you for the question, Congressman. I would say that what banks like WebBank have realized is that when you combine very knowledgeable, effective fintech companies with a bank, you unlock the best of each of those participants. Fintech companies are incredibly customer-focused. They build amazing tech platforms at scale with reach, excellent customer experience, minimal friction, what have you. Banks are very good at underwriting, at credit, at regulatory oversight. They're not necessarily the best at building really great tech platforms. And so when you combine those capabilities, 1 + 1 = 3, if not a larger number. And so I think that's why you've seen over the last handful of years banks coming around to the conclusion that if you can't beat them, join them, and they're better off partnering in order to leverage the capabilities of fintech companies.
So I'm really interested in financial technology, and as the chairman said, Lincoln, Nebraska is a fintech hub for the United States. We'd like to have more. In the case of the state of Nebraska, I think that technology can also be useful in ensuring that smaller community banks, we have about 140 community banks in Nebraska, more state charter banks than anybody would ever imagine. They get access to some of the same tools that larger banks have, like a slick mobile app, an updated consumer interface on their website. These are the types of features that customers, especially younger customers, have grown to expect. The problem is for some of the smaller banks in our communities, they don't necessarily have the bandwidth or the resources to provide these features that consumers are increasingly expecting themselves. That's where, to your point, I think these important partnerships come in. So this is a question for both Dr. Lenz and Mr. Sands. Could you both speak to the potential benefits that fintech partnerships can provide to community banks and their customers?
I'll start with a quick answer. I would tell you that the benefits of a fintech relationship are available to all banks, including community banks. But I would say that in the current environment, banks will need to invest substantial resources to take advantage of any of those benefits. The benefits could be myriad, depending on what they're looking for, from a slick front end or better data analytics to better underwriting, whatever it may be. But in order to unleash the benefits of any fintech relationship, especially given the current third-party risk management guidance, they will have to devote some pretty substantial resources to be able to structure the relationship with that partner and oversee it effectively. And unfortunately, I think that guidance makes it difficult for community banks to live up to that standard.
Thank you for the question. And I would second that. I think that community banks serve, I come from North Carolina. I grew up in the Southeast. Community banks are what serve a lot of small towns. And the big banks don't show up, right, for those kinds of things. The opportunity that fintech allows community banks is phenomenal, but the in a highly regulated environment, it becomes difficult for them to adopt those kinds of things. The only way I think that community banks can stay viable is to offer those kinds of products because it's too easy for consumers to get a hold of things. I think community banks offer a lot to the rural communities in particular. I think they have a place in the United States. And so these kinds of partnerships are instrumental. The idea that a community bank can develop fintech products is, it's not possible. They're too small, they don't have the resources, and, let's face it, even the large financial institutions have trouble. That's why they partner.
So along those lines, let's talk about the recent guidance issued by the Federal Reserve, the FDIC, the OCC regarding risk management for some of these fintech partnerships. Do you think that has a chilling effect on, would it have a chilling effect on some of these community banks being able to offer their customers what a big, large bank can do?
I think it'll have a chilling effect on all banks, not just the small banks, across the board. I mean, if you look at where innovation's coming from, for the most part, it's not coming from banks. Square did not come from a bank, right? But it's afforded millions of small businesses the opportunity that they would only have if they were large. If you look at innovation kind of across the board, there's a reason that it's not coming from banks. So yes, I agree with that 100%.
Thank you, Dr. Lenz. I yield back.
Gentleman yields back. Gentleman from Wisconsin, Mr. Stiles, recognized for 5 minutes.
Thank you very much, Chairman Hill. Thanks for being here today. I think this is a really important topic. I want to start with you, Mr. Polnyapin, if I can. You, in your opening testimony, were talking about kind of the impetus for the creation of your company. Why are people paid monthly instead of paid daily, paid by the hour, meaning the transfer of money, not earned, but why are they not paid on a very regular basis?
Thank you for your question. So people are actually paid every day for a long time.
And then it shifted, right? So exactly. So we go back 100 years, and you carried a 50-pound sack over your shoulder, and you worked your tail off throughout the course of the day. You expected to be paid at the end of the day, right?
Exactly, and society never accepted that employers could hold back someone's pay past that day.
And then these giant ERP systems came in, very expensive, complicated systems, huge global companies, some smaller companies using them as well. And the bookkeeping became so complicated to navigate through, where workers were paid different amounts throughout the day. These massive ERP systems started batching the payment structures, avoid fraud, good accounting standards, and started doing this probably on a monthly basis. Is that fair?
That is correct.
So if a young person comes to the United States House of Representatives, works for the federal government, and they come here and they start a job and they start after the 15th of the month, they're 6 weeks away from their first paycheck. And that young person may need to put a down payment or a deposit on their rental unit. So they're not only going to have to cover this month's rent, they're going to have to put a deposit down, and they're still not going to be paid in the course of 4 weeks. So they're going to hit their third rent payment before they get their first paycheck. And that's true for countless Americans who are taking their first job. Is that right?
That is correct.
And so that's a huge burden on that individual. And further, we've really disconnected work from reward in this country. I think it's one of the biggest challenges we face writ large, outside of just the financial services space, but as we're thinking about our entire benefits structure in the U.S., how we help people get a job, come out of a dependency situation and lift themselves up on their feet. The number one thing we can do for people, work is at the core. And what we've done as a country is disconnected work from reward. And in the case of the employment structure here in the United States House of Representatives, your federal government, in countless companies across the United States, these burdensome ERP systems are actually preventing people from getting paid in a timely manner. Is that fair?
That is correct.
And so in your example at your company, people came to you and said, can I get a loan simply on the money I've already earned? But it's not really a loan, is it?
They wanted the money that they had already earned, and this happens in millions of small businesses across the country where the business owner or the store manager gets asked by their employees for money that they have already earned.
And so it's not a loan, it's simply giving them the money that they already earned.
That is correct.
And so I'm thinking about maybe there's a young woman or a young man, they got kids, it's coming up towards Christmas season, they want to work an overtime shift, maybe they work at Target, maybe they work at a store, if they were a waiter or a waitress and they worked an overtime shift, what would happen? They'd take the money home, right? They'd put it in their pocket. So if the manager came to them and said, hey, Mr. Bartender, do you want to work an extra shift? We're down somebody. And they think, boy, this is a great way I could save a little in my back pocket and buy some presents for my kids. That is a work-reward connection immediately. And if you go to a restaurant, people work pretty darn hard in a restaurant because that work-reward connection is there for everyone. But we see many people not taking that extra shift, not because they're lazy, but because we've removed the work-reward connection that historically existed in a very common way. And I think the earned wage access tools that we're discussing in my discussion draft actually addresses one of the key problems that we've created as a society over the last 100 years, which is a disconnect between work and reward. We do that in a number of ways. I think we have to break those burdens down to help people find that opportunity to help themselves. If your car breaks down and you need $300, if you're a bartender, you can go ask your manager, pick up a couple shifts, and try to walk home with a couple $100 by the end of the weekend. That's quite reasonable. But if you work for countless other companies across the United States of America, and you went into your boss and said, I'd like the overtime shift because I have a $200 issue, you don't really have that opportunity to actually get that money in any reasonably tight period of time. Is that fair?
You can get it now through earned wage access.
You could get it through earned wage access.
Over 100 congressional staffers use our product.
And so I think it's essential. I'll wrap up here real quick, Mr. Hill, if you give me the extra 10 seconds here. But I think it's essential that we look at the discussion draft of the earned wage access bill to give stability to these companies, because I think it really breaks through this burden that many people feel where we have disconnected work to reward and work to access to the wages that you earn. I'll finalize by just asking unanimous consent to submit for the record the press release from Innovation Payments Association.
Without objection, the gentleman's time has expired. The gentleman from Texas, Mr. Green, is recognized for 5 minutes.
Thank you, Mr. Chairman. I thank the witnesses for appearing today, and I'm pleased to have an opportunity to ask a few questions on what I think is an important issue that has been called to our attention. Ms. Spotter, permit me to ask you, do you agree that TILA applies to loans with at least 5 installment payments? If you know.
Yes, sir. I believe that TILA does apply to loans that apply to at least 5
And in
installment
fact,
payments.
if you have a loan with less than 5, then TILA would not apply.
I don't necessarily agree with that proposition, sir.
Well, is that generally speaking what many others agree with?
I think there is a presumption. I think we are still waiting for the Consumer Financial Protection Bureau to provide some clarity around the TILA disclosures, but we believe that they have the legal authority through the Truth in Lending Act to actually expand that standard. And again, this would be a disclosure standard.
I understand. The point I'm making is this. It seems that many of these companies will, with intentionality, structure their loans such that they're only 4 payments. That way they don't have to engage in this debate about whether TILA applies if they move to 5 payments. Has that been the case as you have analyzed these circumstances?
Yes, sir. And what I think is actually really important is, again, by their own analysis, these are not one-and-done loans. They are, in fact, loans that are, you take out one, and then a day later you take out another, and then, or 2 weeks later you take out another. And so even though we have these 4 weeks instructions, the full amount is actually far more significant, which is why the costs are more significant, and it is not a 4-week repayment period. It's, in fact, an ongoing debt.
I understand, but the point that I'm making is that the companies with intentionality are evading TILA, which is something that I happen to believe is important. I think truth in lending is something that benefits the borrower. I also believe that when you avoid these disclosures, you can avoid telling the consumer upfront how issues will be resolved when there's a dispute. And dispute resolution is pretty important, especially if you find that the means by which the dispute will be resolved is one that is not to the benefit, but rather to the detriment of the consumer. So you'd like to know this. I would, and I think most consumers would. And my concern, quite frankly, is with what you have called to our attention as it relates to the companies, these fintech companies, not wanting to be regulated or having to adhere to the same rules that other lenders have to adhere to, by saying that this is not a loan when, quite frankly, as you put it so appropriately, the money that the consumer receives does not come from the business that the consumer works for. It comes from a third party. That third party is making this money available. Now, you can call it many things, but it does quack, and it does swim, and it does wobble when it walks. So, as you have put it, it probably is a duck if it does all these things. So my point finally is this. I'm concerned also because of the statistical information that the staff has afforded us, and I think this is pretty important. Staff has indicated that Black and Hispanic consumers are 63% and 50% respectively more likely to use these buy now, pay later products than white consumers. That's pretty important. Blacks and Hispanics are more likely to make less, earn less, and as a result need these products more, and as a result become victims more so than other folk. They also indicate to us that, let's see, this is important, female consumers are 35% more likely than males to use these buy now, pay later products. Well, we know that females don't get equal pay for equal work in our society. We don't like to admit it, but it's true. Thank you for the time, Mr. Chairman. And for the record, if I may ask that the witnesses please confirm for me that 72.6% of the buy now, pay later users earn less than $75,000 a year.
I thank the gentleman from Texas and ask the witnesses if you would confirm that in writing to the gentleman from Texas. And now I recognize the gentleman from South Carolina, Mr. Timmons, for 5 minutes.
Thank you, Mr. Chairman. Bank fintech partnerships have created significant competition in the financial services industry by providing consumers with the services they seek. The environment created through open banking has yielded financial freedoms never before seen by consumers. Through products like earned wage access or buy now, pay later services, consumers wield the flexibility to meet their financial needs at the touch of a button. With the increase in banking tech relationships, we have seen many banks face increased scrutiny by bank examiners and enforcement staff simply due to their business model. This increased regulatory scrutiny has no basis in real-world evidence and actively stymies innovation. Ms. Kelly, do you agree that it is crucial for federal regulators to continue working with market participants to ensure they create pragmatic guardrails around bank fintech partnerships instead of pursuing regulation enforcement due to the fear of potential harms?
Thank you for the question. So we certainly agree that it is very important to work in partnership to ensure that the necessary guardrails are in place, but the guardrails that are put in place are appropriate and continue to foster innovation, as we are seeing in the partnerships that you described.
And creates predictability as well. Mr. Sands, some have criticized bank fintech partnerships in the wake of the Paycheck Protection Program on the grounds that such partnerships allow for high levels of fraud within the program. Is that a fair assessment?
Absolutely not, and thank you for the question. I think this is another example of very limited number of cases, being the basis for tarring all fintech programs with the same brush. Although, the McComb study out of the University of Texas and the subcommittee report indicated that there were elevated levels of fraud in PPP. I can tell you the Web Bank provided over 117,000 loans for over $3 billion in PPP. And in that same McComb study, our lending was equated with that of traditional lenders because we did not see escalated fraud rates. And in fact, we actually received a letter from FinCEN that I included in my written testimony that thanked us for our BSA program because it did lead to information that was the basis for successful prosecution of a PPP fraud.
Sure. I would argue that the PPP loan program was legislatively flawed. It was not implemented poorly. We needed to have better protections on our end. Open banking has the potential to revolutionize the financial services industry by allowing third-party developers and financial institutions to access and share consumer financial data in a secure and standardized manner. Along these lines, the CFPB recently issued a long-anticipated notice of proposed rulemaking, further defining Section 1033 of Dodd-Frank, which serves as a first step to creating clear rules of the road for data sharing between banks, data aggregators, and third-party fintech developers. Ms. Kelly, again, what lessons can we learn from rules similar to 1033 in other jurisdictions such as Europe, and did the CFPB correctly implement these lessons in the NPR?
So thank you for the question. As you can imagine, we're working our way through the NPRM, and we'll be commenting as it is, in fact, a very lengthy document. But we welcome movement on the open banking front. We do think it has the possibility to revolutionize the financial system, including through payments. What we have seen as we look in other jurisdictions that have implemented open banking rules is the need to ensure that the incentives are aligned, that industry has the incentives to engage in these partnerships, which we think are the ones that are going to unlock the key.
Sure. Quick follow-up. The NPR scope is currently limited in nature to the use of checking and prepaid accounts, credit cards, and digital wallets. What would the pros and cons be of expanding the scope of 1033 from CFPB's initial NPR to other financial tools?
Well, from our perspective, obviously, we are focused on payments. ETA, we are a payments trade association, and so the focus on payments, we think, we are focused on payments and think that's appropriate. It's obviously been a long time coming, and we're going to work through this NPR first.
Thank you. Dr. Lenz, in an article that you co-authored, you advocated for the advancement of legislation that will create a federal regulatory sandbox to help fintech startups better navigate the thicket of existing regulations. Can you describe why you think a federal regulatory sandbox is a legislative solution to foster the development of new financial products and services?
Thank you for the question. Yes, sir. I believe that a federal sandbox is necessary. There are about a dozen states now that have sandboxes, which are fantastic, including my home state of North Carolina. However, most fintechs don't want to operate within one state. They want to operate nationally. And so the opportunity to have a federal fintech sandbox would allow folks to develop new innovative technologies that could be used across the United States, which I think is what everybody wants at the end of the day.
Sure, it seems predictability is something we're pursuing. Thank you, Mr. Chairman. I yield back.
I thank the gentleman from South Carolina. Now the gentleman from Tennessee, Mr. Rose, is recognized for 5 minutes.
Thank you, Chairman Hill, for holding this important hearing and very timely hearing, I might add. And thank you to our witnesses for being here today and sharing your time and expertise with us. Dr. Lenz, in your written testimony, you noted that the United States has been the undisputed leader in financial services around the world for the past 75 years, in no small measure due to the willingness of its various constituents to take chances and embrace innovation. Do you worry that there is a risk that the United States might overregulate new and emerging fintechs, and could overregulation put in peril the current position of the United States as a global leader in the financial services industry?
Mr. Rose, thank you for that question. I do believe that overregulation is always going to be problematic, and it has to be checked. I think regulation is appropriate. I think consumer protection is appropriate. However, I think that has to be done with incentivizing innovation at the heart of everything we do. We do take risks. As I said in my opening statements, that's part of what makes us Americans. We have seen what happens, what fruit's been born from that risk-taking, and it is, that we are the undisputed leader in the world. That's come about because we've been incentivized to innovate. I think that keeping that sort of incentive open will continue to lead us down that path. The problematic regulation can certainly stymie that or slow it down significantly, and I don't think that's where we want to go.
Thank you. Mrs. Kelly, I'd like to ask you a similar question. Do you worry that overregulation of new and emerging fintechs might cause some fintechs to relocate abroad to friendlier jurisdictions with less restrictive regulatory environments?
Thank you for the question. Yes. So, we think it is, again, we are not anti-regulation, but we are pro-smart regulation. The regulation has to encourage innovation if we're going to continue to see the kind of advances that we have seen. And so, we are always focused on and do worry about regulation that stifles that innovation.
Thank you. And Mr. Sands, I'll go ahead and pose the same question to you. Do you worry that overregulation of new and emerging fintechs might cause some fintechs to relocate abroad to friendlier jurisdictions?
Absolutely. I worry that overregulation will have a dampening effect on innovation within the U.S., that it may lead to innovation moving abroad. I worry that the current regulatory environment is one that has become so intense that, banks like my own that have been focused on bank fintech partnerships for 25 years and arguably were the source of FDIC's proposed guidance on how to run those third-party lending platforms the right way, is seeing the most intense regulatory reviews in its history.
Thank you. Mr. Palaniapan, and hopefully I'm pronouncing that correctly, but according to a study conducted by Branch, approximately 48% of hourly employees have no savings, and 83% have less than $500 saved. Will you describe how innovative products like earned wage access are allowing consumers of all walks of life to manage their finances differently and in such a way that could actually help them grow savings?
Thank you for your question. We see with earned wage access, just with our customers, that our customers are avoiding $1 billion a year in overdraft fees, and that can go to savings. We also see other things. On the overdraft fees, it was interesting. I met with a customer of ours from New York. When she came to meet with me, she brought a journal with 27 days on which she had avoided overdraft fees because she used Earnin. And so there's a lot of cost savings. People are paying their bills on time and not getting late fees on bills. And so that's money that can go into savings. We also see that incomes go up when someone starts using earned wage access. And so like Congressman Stile mentioned, people are actually more eager to work and they get more shifts and they get overtime. Lots of my customers cannot afford to lock $50, $100 in their gas tank. They fill gas $10 at a time. If something unexpected happens, then they can't buy gas they used to miss work. Now they download the previous day's earnings and they go into work. They're working about 3 hours more per week. There's also lots of interesting things. If you work at retail, there's different types of jobs. With some jobs, you're tied to a particular store. And there's other roles where you're tied to a department and you work across multiple stores, and that role pays higher. One of our customers was offered the higher paying role and did not take it because she could not afford to front the gas money and wait for reimbursement.
Thank you. I appreciate your answers, and I yield back.
Gentleman yields back. I ask unanimous consent for submitting a letter to the record dated October 23rd, a letter from the American FinTech Council to the Center for Responsible Lending about their report on earned wage access. Without objection, so admitted. I want to join my friend, the ranking member, for welcoming our former colleague, Lacey Clay, to the hearing room today. We miss Mr. Clay on this committee, and I want you to know that your relatives, both current and former in Arkansas, are well represented in the 2nd Congressional District. I want to thank all the witnesses for their testimony today. Excellent panel. Without objection, I'd like to, without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses via the chair, which will be forwarded to the witnesses for their response. And I ask each of you to respond as promptly as you are able. With that, this hearing is adjourned. Thanks.